Well, let's keep the conversation going here. Let's welcome in Blerina Uruci, who is the Chief U.S. Economist at Rowe Price. How about your reading on where we sit with some of the economic data that's come out over the course of this week and what that all means for what the Fed may do next from here?
Thank you for having me. Yeah, let's great discussion on the details of the CPI report, by the way. And what I would highlight is this, that even though it came in line with consensus expectations, it doesn't mean that it's good for the markets or it's good news for the Fed. What we saw was that the sequential pace of inflation actually strengthened a little bit. And we know that the road to normalizing inflation and bringing it back down to the Fed's 2% target is going to be a bumpy and long one. But I think what this report highlights is that there are some risks here that the progress that we've seen on inflation may be stalling if the economy rebounds, as the January data so far suggest. And what data are we talking about here? Is the retail sales report that we saw this morning that suggests that consumer spending rebounded quite strongly in January after the slowing in Q4 of last year. And I think here it's very interesting with the retail sales report because we know we're going through a process of transition from spending on goods and towards services. And we've seen that in the PCE consumption data so far. But what the retail sales report for January suggested is that goods in this transition are not really suffering a ton. And so I think this in itself could put a little bit at risk the progress we've seen in goods inflation in the tail end of last year.
I mean, if we can dig into this a little bit more, Blerina, because we saw, for example, department store sales up big in January, 17.5%. Electronic sales were up, which surprised me. I have seen some theorizing that people were waiting for post-holiday sales. In looking at retail results, discounting is rampant. So I wonder if you can get that sweet spot where prices are not increasing on those goods, but people are still spending.
Yes, and this is why I think the Fed is also not overreacting to 1 month's data. We know that in January, we also have some seasonality issues with both the payroll report and consumption data. So we need more than a couple of months to make sure that this is a trend and it's not just driven by one-off discounts. But I think what I would say is that the economy under the hood seems pretty strong. And the risk for the Fed is that inflation and wage growth are lagging indicators. And so the first step would be that if we have a reacceleration in the economy, the housing market stabilizes, that inflation, not right now, but in 3 or 6 months' time, is going to reaccelerate. And I think this is what's going to underline their reaction function and what they do with monetary policy this year. There is another element here that the Fed has stepped down the pace of hiking to 25 basis points per meeting. I think at this point, the bar is very, very high for them to transition back to the sort of fast pace of tightening monetary policy that we saw last year. But everything together, it means that they don't need to aggressively change their forecast about the terminal rate at every meeting. They could do it gradually because they have a longer runway now to tighten policy.
Blerina, I'm putting this question to all economists that we talk to here. Do you see a no landing scenario playing out in the economy where inflation is just going to stay high this year, and as a result, interest rates are just going to have to stay higher for longer?
Well, I think this is it's a great expression that we've coined recently. Here's what I think the problem is with that. Inflation that stays elevated, it's problematic and unacceptable for the Fed. And the reason for that is that the longer we stay with inflation at 4% on an annualized basis or a year-over-year basis, the more likely it is that consumer behavior will change with regards to inflation expectations, how they spend, and how they ask for wage increases. So in that sense, I think higher inflation for longer is not necessarily consistent with a no landing. I think higher inflation for longer prolongs the tightening cycle. It increases the terminal rate, the rate at which the Fed will stop. And I think it increases the chances that financial conditions eventually tighten too much for the economy and it it increases recession risks.
All right, we'll leave it there. T. Rowe Price Chief U.S. Economist Blerina Uruci. Good to see you. We'll talk to you soon.